name is Seth Forman, president at Socialsuite. We're an ESG technology solution, specifically working with microcaps and small cap companies. So we have an exciting panel today. Our topic is going to be about top trends facing microcap companies. So I want to welcome everybody to the discussion. And microcap companies face unique challenges and opportunities in the market due to their smaller size, limited resources, and higher susceptibility to market volatility. Today we have gathered a group of experts from various backgrounds to share their insights on the current trends affecting microcap companies. We're going to be exploring topics such as limited access to capital, increased regulatory scrutiny, compliance, and difficulty in gaining visibility and greater volatility and limited institutional ownership. We hope that this discussion will provide valuable insights in the current landscape for microcap public companies and help our audience gain a better understanding of the challenges and opportunities facing these companies. So without further ado, let's get started. I'm first going to introduce our panel. So on my left, we have Erik Nelson, president of Coral Capital. Next to Erik, we have Becky Popoff, director of B. Riley Securities. Joseph Oltmanns, SVP of Corporate Services at OTC Markets Group. And then we have Rudy Singh, who's the CEO of Electro Filings. So to start off today, we're going to go through each member of our panel. They're going to introduce their companies, and then we're going to go from there. So Erik, why don't you take it away?
Hey, good afternoon. I'm Erik Nelson. I'm the president of Coral Capital Advisors. We're an advisory services firm. We currently provide services regarding DTC eligibility, assistance with corporate actions, helping clients navigate the regulatory approval process with FINRA. And we've been active in helping clients that have been need assistance with a 15C211 and prepare the documents and get it out to a market maker that can file it on their behalf.
Becky?
Hello, Erik. We've worked together in the past. Good to see you again. It is great to be here. Thank you, Seth, for having me on this panel. Planet MicroCap, it's great to be sponsoring another wonderful event. I'm Becky Popoff, and I'm a director with B. Riley Securities. We are a full-service investment bank based in Los Angeles with offices across the U.S., and I sit within our capital markets advisory group and run our OTC advisory practice, which focuses on helping both domestic and international companies in achieving compliant access to the U.S. capital markets, specifically through our OTC advisory practice, which I'll dive into in a bit. So thanks again for having me, and excited to be here.
And Joe.
Thank you, Seth. Hi, I'm Joe Oltmanns, Senior Vice President of Corporate Services at OTC Markets Group. I've been in OTC Markets for 13 years. I think I joined there when we were employee number 33. We're now about 150 employees full-time. So I've come a long way. I had a good long run at OTC since I joined. But my role really is new listings, whether it's a company trading on Pink, looking to uplist to QX or QB. That's my role. It's cross listings. It's looking at companies on foreign exchanges that are looking to, say, access the U.S. market. I work in that area too. And then also it's direct listings, which we're seeing more and more of, where companies are choosing to go public on our market without the need of raising capital. As a market, we're 10,000 companies across the board, both foreign and domestic. What we've done since I've joined OTC is really segment the market to different tiers. Many of you may know the old terms of OTC, meaning pink sheets and OTC bulletin board. That's long gone away. It's now been replaced by OTC Markets Group, and we operate the OTC QX, the OTC QB, and the pink market. Again, glad to be here today. If we don't get through everything on today's panel, we are here throughout the event. We have a booth downstairs. Feel free to stop by.
Thanks, Joe. Rudy?
Yes, hi. First off, Planet MicroCap team, thank you for allowing us to sponsor. Much appreciated. My name is Rudy Singh from Electro Group of Companies, which is Electro Filings, that does a filing agent work with regards to all the publicly traded companies that are here. We provide from Form IDs all the way to going public, etc. In addition, we have Electro Sites, which is an IR firm that assists in creating the web pages for publicly traded companies to meet their requirement via SEC rules and regulation. We're based in New York City, And again, I'm happy to be here and to be able to share our common day-to-day errors and omissions that we've seen companies go through when either going public due to the trends and changes that are happening in the market at present. So I'll hand it over to Seth.
All right, great. Thanks, Rudy. Okay, so let's jump into one of the first trends that we're seeing facing microcaps. So the first topic is really related around market volatility. Everything from we're seeing inflation in a variety of different markets. That's been leading to interest rate hikes. We have the war in Ukraine, so there's a lot of geopolitical issues going on around the world, and this is all impacting a variety of markets and leading to different pressures in the markets, including non-compliance issues across different exchanges. So let's talk about this for a moment. Maybe we'll start with Joe over at the OTC Markets Group, who has a broader perspective of what's happening related to market volatility. So Joe, over to you.
Yeah, there's no doubt, I think it's a very challenging time, especially when it comes to microcap. Looking at NASDAQ's total companies, there are about 3,000 companies on NASDAQ. About 400 right now are in non-compliance, whether it's a bid price issue or stockholders' equity deficiency or market cap deficiency. About 10% or more of companies on NASDAQ are below compliance. And so it kind of comes down to what do companies in that situation do. For example, if they're below $1 bid price, for example, do they reverse split or do they move to OTC? We've seen a lot of companies, naturally, I think, just by historically speaking, they've done the reverse split to rectify their situation on NASDAQ or NYSE. In most cases with reverse splits, if a company is doing well operationally, or if there's good news behind a reverse split, it tends to maybe work out. But if a company, based upon my experience, if it's not doing well operationally and chooses to effect a reverse split, it's just putting a Band-Aid on a problem. And what typically happens from our lens is we see a company choose to reverse split, stay on NASDAQ, and then within 6 months later or a year later, fall right back out of compliance. Their market capitalization has been kind of cut in half since that move, and then they come to OTC, and hopefully they hope to do better. Again, it's kind of a Band-Aid approach. We've seen other companies tend to not affect reverse splits, come to OTC, save a ton of money, regroup, and then, if they choose to relist back on NASDAQ down the road, so be it. But just, I know I'm biased from my lens, but just be aware of if you're in the NASDAQ situation and you are below $1 and you do affect the reverse split, you are inviting a lot of shorts, right, into the stock as well, especially if the company isn't doing well going forward. So things to think about. I'm happy to provide more data. I have it downstairs by our booth. I'll be around again, like I said, all week. Something to consider, I think, when companies are facing, NASDAQ and non-compliance issues is when you're looking at OTC versus the exchanges, do talk to us. We have some good data points, some good stories, good examples to show you.
So I have a question back to you. So let's say in situations where if it is a NASDAQ company, they drop below $1, what's the timing look like when they should be considering these different options? Should it be something they should be looking at immediately? Should it be something, a certain amount of months down the line?
Mm-hmm. We try to reach out, to be proactive and let companies know what the process would be in coming to our market. Companies are usually given 6 months to regain compliance to start, and then sometimes another 6 months beyond that. But I would say within that first 6 months non-compliance notice, it's good just to kind of get a hold of OTC, know what the requirements are to join our market if you are eligible, and then what the timing and process would be to follow it. One other trend that we've seen around delisting more so earlier this year is deregistration. And that's a really good value proposition. So for companies on the exchanges that have less than 300 shareholders can actually deregister from the SEC. That saves companies tons of money, probably upwards to around $1 million per year on expenses. So for companies that are tightly held, don't have a large shareholder base, don't really see the need and value of being on a big board, whether it's New York or NASDAQ, deregistration is another topic we're seeing, more and more of as companies want to control more costs.
Thanks, Joe. All right, so we're going to go into the next trend here, kind of leading into talking about capital and investors. So companies, particularly microcap companies, are constantly looking for ways that they can expand the amount of investors that would be attracted to their company. Now, international companies in particular are looking at ways to establish trading, ideally in markets like the U.S. Quite an important topic that we want to cover. And Becky, you're an expert on this topic. Can you expand on this a bit more?
Of course. And as I mentioned earlier, I run our OTC advisory business. Only fitting that I'm sitting next to Joe at OTC Markets. We've worked together several times, so it's great to see you again. Joe really touched more on the domestic side of things, where we do work with domestic companies that want to establish trading on the OTC, but my primary focus is really going to be touching on this trend with international companies really looking to gain exposure in the U.S. and establish this cross-trade, also known as secondary trading to some. So, it's a trend that I think's been around for quite some time. It's a trend that's only continuing to be built upon. And the way I can get involved with companies and helping them establish secondary trading is OTC Markets requires these companies work with a sponsor, and B. Riley is a qualified investment bank sponsor. So we've really turned that role of sponsor into an advisory relationship where I'm truly hand-holding my clients each step of the way to make sure they know what they need to be doing to get to where they need to be to successfully be trading on the OTC Markets platform. And so, like I said, the primary discussion that I'm touching on is why is this a trend for international companies? Why do they want to be in the U.S. and how B. Riley can really be a part of that process for them. I see one of my old clients back in the room too, so good to see you, Charlie. There's different ways to achieve cross trades. Like I said, my focus is always for companies on the OTC Markets platform, and so this is a trend for me. This is a trend that I believe in, and there's so many reasons why there's a huge advantage for companies to do this. Number one, it creates efficiency. It allows U.S. investors to trade your stock in U.S. dollars in U.S. trading time. So I'm working with the company to help them create their U.S. ticker so they can then work with myself and OTC Markets to get upgraded to the QB or QX. So we're creating a convenience for the U.S. investors so they can trade the stock. This only then, diversifies your investor base. You're reaching a larger audience, which then creates more visibility, and hopefully, of course, the liquidity you aim to see in your stock. So those are some really strong points as to why it's a trend and why it's an advantage for international companies to go this route. Another huge advantage is, as a foreign private issuer, these companies can rely on the foreign private issuer exemption, also known as the 12G32B exemption. And this exemption really is a great benefit for international companies that are already public outside of the US, because it allows them to rely on their home country's protocols and disclosure standards. So they don't have to go through the rigid procedures of becoming an SEC reporting company. They're relying on their public market, say in Canada, what the TSX requires of them, and that crosses over to the OTC Markets platform. So it's a really huge benefit for these international companies, and again, why I think it is constantly trending. And I think, let alone there's over 7,400 companies trading on the OTC Markets platform, and that number is only continuing to grow. It's the biggest platform for international companies. And for this reason, this is why at B. Riley we've created this OTC advisory practice, because we believe in the platform. We believe it's a huge benefit for international companies to take that step to really get in front of the U.S. audience, and it's just my goal to really be their partner through that process to make sure they know what they need to be doing to successfully, make that transition into the U.S. So that's really where it all kind of lies down to for me in terms of the international market and how we get involved.
Oh, great, thanks, Becky. I guess
Yeah.
a follow-up. Oh, sorry.
No.
I was going to just build on what Becky was saying. Overall, the big takeaway. So we're a market of roughly 10,000 securities. About half of those securities, if not more, are foreign securities. I think when people think of OTC markets, markets, they think of, nano cap, micro cap, domestic companies. But actually we're not. We're a very global exchange with a lot of foreign companies on our market. The reason why is we have a very good, simple value proposition. It's that companies can essentially have the same experience as if they were on NASDAQ or NYSE at the fraction of the cost. We don't require SEC registration for foreign companies to join our market. So that's why Heineken is with us, or Roche is with us, or Adidas is with us. They're very large global companies that choose OTC markets over the exchanges, simply because we're much less costly and offer the same exact experience as a New York or a NASDAQ. But going into trends, Seth, there are, again, I work more on the domestic side, but if you look downstairs at all the different companies presenting throughout the conference, you'll see a bunch on TSX, for example, or ASX and OTCQB, not NASDAQ, not New York. And the reason is why is because we're a very cost-effective solution for foreign companies. What I wouldn't mind Becky touching on real quickly is say a company approaches, say you're on TSX, for example, or ASX, right? And they'll come to OTC or come to Becky and say, what do we have to do, right? What's the process to which, what do we have to do to get quoted in the US? I wouldn't mind, Becky, if you would kind of go over that a little bit in terms of what the timing of it and the steps involved.
Of course. So like I said, I work with domestic and international companies. It's ultimately the same process. But for international companies specifically, if they're already public on the TSX, for example, some companies may already have a pink ticker in existence, some may not. Generally speaking, most will need a FINRA 15C211 filed, which is the market-making application which clears these companies to trade in the U.S. So not only am I working with these companies as sponsor, but I'm also working with them in FINRA to clear their market-making applications so they can actually trade in the U.S. So it's really a two-part process that I can be involved in from all angles. So I'm really helping spearhead the entire thing for them. Like I said, if they don't have a ticker, FINRA creates one. If they already have a pink ticker that needs to be cleared, FINRA's looking at that ticker that's already in existence and clearing that to be traded. Once FINRA gets through their review and has cleared them to trade, that's when I work with OTC markets to really get them through the OTC application process so we can successfully upgrade them from the pink market onto the QB or QX, whichever tier that they qualify for. Ultimately, with us providing the sponsorship letter at the end of the process. So all in all, it's about a 2 to 3 month process. It can go shorter, it can go longer. It just really depends on how quickly all parties work together. But I'm constantly peppering everyone to make sure we get through it as quickly as we can. But for an international company, that 2 month mark is a really good basis for how you can do this quickly, efficiently, and cost effectively, because it's huge when it comes to costs for these international companies that I work with. So I think that's a really huge advantage when it comes to timing and cost.
Great. Thanks, Becky. So speaking of FINRA, it's a good segue into our next trend here. So we're seeing a lot of changes in corporate actions and services towards issuers. FINRA, in particular, announced a new corporate action plan that we want to hear more about. So, Erik, can you maybe add a little bit more color on what's going on with FINRA?
Yeah, so as most people know, the FINRA regulates the over-the-counter market. So when a company undertakes a corporate action such as a name change, a reverse split, re-domicile, or a merger, they have to submit the action to FINRA for ultimate approval. FINRA has announced recently that they're going to provide a new, basically a project management service or a platform to handle the corporate actions. In the past, you would submit the appropriate paperwork or the form to FINRA. They would respond with an email, a list of about 16 plus questions. You would do your best to respond to them, and you might find the next email came out with another 10 brand new questions. FINRA has taken a lot of criticism for this over the years. And so what they have done is announced the new corporate action process. It came out about a month ago in an announcement, and they're going to implement it in June of this year. This should really streamline the process and make it go a lot smoother and a lot easier. Additionally, last year, we saw that FINRA started putting a 90-day timeline on a corporate action for approval. It used to be a couple years ago, corporate actions were dragging out sometimes 7 or 8 months for a simple name change. they would lose documents, not read emails, not read documents. So they've really, with the changes that went through with 15C211 and back in 2021, and OTC markets starting to do approved direct listings, FINRA has, I believe, felt a little competition and started to improve the process, which is ultimately going to benefit the over-the-counter companies because it's a lot easier to get things done or a lot quicker, and that ultimately reduces your cost. Back.
Erik, what were some of the reasons why the name changes took so long? Do you have any idea?
A lot of it was they would give the simple corporate actions to the newer examiners. I hate to say it exactly like that, but they had people that weren't as well trained. They've also reformed their hiring process to get more experienced people with industry knowledge and legal knowledge into those positions. And that's really sped things up.
Okay. Thanks, Erik.
Yep.
Any other comments about FINRA? No?
No, that's
Okay. Well, that's a good segue into another corporate action trend that we're seeing. So there was recently now a delay on a 15-day approval to go on an exchange. So, Rudy, you're an expert in this topic. Can you talk more about this?
Certainly, Seth. So as you guys know, there's been a 15-day application process, as previously mentioned by Joe earlier. The SEC is now asking that, you do that application with NASDAQ to get approved. And what that does, it's putting stress on companies that are foreign, obviously trying to basically adhere to all these rules and regulation here in the United States. And as such, they sometimes run the risk of their financials going stale. And you know what happens when that happens, right? It's like redoing this process all over again. The cost that's endured having to find that additional finance. The fact of them having to go through the entire process from the beginning and making sure that all their T's are crossed and their I's are dotted. Now, many of which has fallen apart, which we've seen over the past 6 months. They have reverted back to staying private or has gone to a lower exchange just because of this burden. The SEC also went ahead and they proposed that an acceleration of this rule be mandated into effect. And what happened is, though it's there, they're still dragging it out. And as such, these companies are still struggling accordingly. So, there's kind of like no win-win. They're saying, yes, we want to have these individuals in place so that, all of these things are measured and they're in the right order and everybody can go ahead and get the benefits and everything is streamlined. But in the end process is, what are we really losing? We're losing the ability for them to be able to trade. They've gone this far, reaching the end milestone of getting everything in order, their audits, ensuring their filings are on time, working in that timetable, the underwriters, et cetera, and then at the end, when they're supposed to start trading, they're stuck with this 15-day, and in turn, pushes back. So, that's where we've seen Seth happening across the board.
Thank you.
Well, I think, Seth, you've been asking us all the questions. I have some interest on the ESG side as well. So since we're on the topic of raising capital, what trends are you seeing on the ESG side that, we should all kind of consider?
Yeah, so on the ESG front, and for those of you who don't know, ESG stands for environment, social, governance. So on the ESG front, it's quite a trend right now. And for those that have been watching this, there's mainly 3 different types of influences that we're seeing in the market. One is related to investor capital. It's about $10 trillion of investor capital in the market with funds that require ESG-based metrics. So for companies that have ESG data and ESG reporting, they could potentially capture that. If you don't have any of that data, then those funds and those investors will screen out companies if you don't have that information. So we have a number of examples of customers that we've worked with that's been able to raise capital because of having that ESG-based information. Another trend that we're seeing related to ESG is an article that I recently wrote as part of the Planet MicroCap spring issue related to supply chains. There's a lot of big, large cap companies that are now mandating ESG reporting down into their supply chains and down into their vendors. So if you're a microcap company and you sell product up to a larger organization, potentially you may be getting RFPs, or you may be getting specific mandates and requirements related to ESG-based information. So making sure that you're preparing for this is important. So that customer trend we're going to continue to see through 2023 and into the future years. And the last one is around compliance. So the SEC has a climate disclosure ruling that's currently being reviewed. It actually was expected to pass this month in April. We'll see if it does. It's likely going to either happen now or into the next few months. And that's going to mandate all public companies. There's going to be a rolling period. It's going to start with the larger organizations, and it'll be then applicable down into smaller public companies, but it'll mandate certain types of emissions data, climate risk analysis, and other climate-related information, all related to climate risks. So being able to keep track of that, understand that, and making sure that you're ultimately ahead of these certain compliance issues that are coming is important. So on the ESG front, there's a lot going on that front. So thanks for the question, Becky.
Of course, and obviously, as you said, with compliance and everything's constantly evolving, with the ESG regulatory changes, what are your thoughts on those changes that are coming, both from the SEC and out of California?
Yeah, and the SEC and then in California, which is interesting. On the California side, they have a climate proposal in play right now. It's a climate bill. Hasn't gotten as much press. There was a failed effort a couple of years ago, and now it's getting a lot of traction. And in that specific scenario, they're potentially going to include Scope 1, Scope 2, and Scope 3. So Scope 1 and 2 are more direct and indirect emissions from an organization, and Scope 3 includes all of your supply chain emissions. So anyone that does business, now this is more applicable to start for very large organizations that have over $1 billion in revenues, but eventually it's going to include other organizations, particularly if it includes Scope 3, which will then require all the suppliers related to that organization to provide this their emissions data. So it's another one to watch through the year. All right, so I think that's we covered a lot of different trends today. Maybe we'll go through each panelist and talk about how, and if anyone has any additional questions that they want to contact any of the panelists, they can kind of contact you. So maybe starting with Erik.
Yeah, so our website is coralcapital.com. Secondary site is dtc.coralcapital.com. If you have any questions or if there's anything we can do for you, please reach out, and we're happy to talk to you and see if we can be of assistance. Becky?
Thank you, Erik. Again, my name is Becky Popoff. I'm a director with B. Riley Securities. I also have a booth downstairs, so please feel free to come by, say hello. If there's anything further that you'd like to understand on how the process works, please let me know. Joe's a great resource as well, so obviously we both can speak to anything you'd like to learn more on from a OTC standpoint as well when it comes to cross trading or direct listings. So thanks for having me. I have business cards on me, so if you'd like my contact information, please come grab one.
Likewise, we are downstairs for the remainder of the conference. I was employee number 33 joining OTC, so my email is really easy to contact. It's joe@otcmarkets.com. If anything does pop up, feel free to reach out. Thanks again.
We're also downstairs in the booth. We're here for the rest of the conference. It's Electro Filings. So Rudy at electrofilings.com and Rudy at electrosites.com, both the IR service and the filing segments, IPO, etc. Thank you.
Thank you. And so, and finally, again, Seth Forman, if anyone has any ESG-related questions, we have a booth downstairs, again, with Socialsuite. Feel free to drop by our booth. So thanks so much for your time today, and that concludes our panel. Thanks, everybody.
That's it.